What are my views on index funds? Well, sometimes they can be extremely useful. For example, you only have 5 to 10 investment options in your 401k, but yet you have an S&P 500 type of index. That at least gives you diversification in equities, and you don't have to sit and try to manage your 5, 10, 15 investment options in your 401k yourself. From my perspective, though, I look at throughout my 21-year career managing money, and it seems that every time index funds continue to get more and more notoriety is the top of the market. We saw it back in 1998. Many people would write articles. You don't need a financial advisor. You don't need an active portfolio manager. Just throw your money into an S&P 500 and you'll be fine. That's not the case. We saw the same thing in 2006, 2007. Index funds are doing great. Managers of actively managed funds aren't doing that well. Therefore, what do we need them for? What do we need financial advisors for? Just put all your money into the index and wait until you retire. That's not true. We went through a period for 12 years where a dollar invested in the S&P 500 12 years later was still worth $1. But yet along the way, at times it was worth much more than $1. So I don't mind index funds. I use them for many clients' 401ks because that's where I start investing with my clients. Once we've identified exactly what return they need each year from their money, I look at their 401k options. Many times their options are not that good, but if they have an S&P 500 index, I will use that. But from my side, when I am managing taxable investments or I'm managing IRAs or Roth IRAs, very rarely do I ever use an index fund. If I do, maybe it's an index exchange traded fund so I can sell covered calls and try to generate additional income off of that investment versus just relying on the dividend yield. But once again, in 2016, we saw a tremendous amount of the investing public move their money into index funds. And once again, the argument of why do I need an advisor? What good is actively managed mutual funds because the index fund did so well? Yes, they have low fees. There's no doubt about that. It's very tough to compete with that. The flip side is that from 2000 to 2003, had you have held that same S&P 500 index fund, collectively you would have been down about 40%. When the market started falling apart in 2007, once again, it didn't matter if you had the S&P 500 index or not. You're going to continue to lose money until the market turns. I think a better strategy is, in a market as volatile as this one has been over the last couple of years, is looking at individual stocks. The S&P 500 has several sectors that make up the index. Not all of those sectors go up at once. It's much better to hire your own portfolio manager or find a financial advisor that's going to go out and look for individual stocks. Buy those stocks at the right price. You actually can reduce your risk by buying the stock low, letting that stock go up 5 or 10%, selling it, getting that money out of the market. Whereas an index fund, if you're just buying and holding, well, then you're going to make as much money as the market offers. And for many of you baby boomers, you don't have 3 to 5 years to watch this market decline and then come back. And I'm not suggesting it's going to decline for the next 3 to 5 years right now. But my point is had you have been retired and you have your money in an index fund in 2000, you waited a minimum of 3.5 years to start getting money back. The problem for many of you baby boomers now with investing in equities, you got to understand, watch the Dow Jones, watch the S&P 500, watch the NASDAQ, watch the Russell 2000. You have extremely large companies, mid-sized companies, small cap companies, and on a day in and day out basis, many times those stocks inside of those indexes, they go up and down about the same percentage. So again, diversification is okay, but if the market is really going to be choppy and it's headed for a decline, not having exposure to the market, whether it's an index fund or an individual stock, is better for you. At least with individual stocks, we can customize your portfolio to have the individual stocks that should be least affected by whatever concerns we have in the market. So again, little concern with the market right now and index funds because again in 2016, the general investor decided that they were going to move money in an index fund, and in my 21-year career, when they've done that before, the top of the market is right around the corner. But best of luck investing until next time.